Good day, everyone. Trust you're doing well today. Today, we're talking about how the market traded last week and what may happen this new week. So, if you actually looked at last week's final number, right, you probably think nothing much really happened. The market actually closed the week down, just 0.20%. That doesn't sound exciting at all. But whatever I told you that sometimes, the most important weeks in the market are actually, the quiet ones. Because while many people are waiting for a big move, the market was quietly sending us clues about what will happen next. And if you know how to read those clues, you will have a much better idea of whether this rally is getting ready to continue or if it's starting to run out of strength, or if the correction is over, or if any correction even happened at all. So in this video, we're going to break down exactly what happened in Nigerian stock market last week, why this small movement matters more than most people think, and two signals every investor should actually be watching this new week. So let's get started. The Nigerian stock market spent the entire week, which was last week, moving inside a very tight range. It stayed between roughly 241 600,000 and 243 500,000 points. And by the end of Friday, the All-Share Index closed at 243 462.13 thousand points. Now that may sound like a lot of numbers, but here's the simple part, right? The market started the previous Friday at 243 954,000 points. By the end of last week, though, it was 243 462,000 points. That's a difference of just 492 points and minus 0.20%. Let me put that into perspective for you to understand. Now imagine you invested 10,000 naira in a stock that followed the market. A 0.20% drop means your investment would only be worth around 9,980 naira. That's only like 20 naira difference. It's such a small move that on its own, it doesn't tell us the market is in trouble, right? In fact, this kind of movement is what traders call normal volatility. Volatility simply means how market prices, move up and down. Some weeks the market moves a lot and some weeks it barely moves at all. So last week clearly belonged to the second group. Now let's see how the market actually behaved each day of last week. Monday wasn't actually a great start. All right. The market dropped 0.90%. At first glance, that looks worrying, but some investors immediately wondered if the rally was over. But then, something interesting happened. Tuesday came, and instead of another heavy fall, the market barely moved. It closed almost flat. That tells us buyers and sellers were evenly matched. Technically, what was happening was nobody was really taking control. Then on Wednesday, buyers stepped back into the market. The index gained 0.31%, showing that confidence hadn't disappeared entirely. Thursday came, and Thursday brought another small pullback of 0.14%. Again, nothing dramatic. Then on Friday, buyers returned once more. The market gained 0.60% and finished the week on a stronger note. So instead of falling every single day, the market kept switching between gains and losses. Down, flat, up, slightly down, then up again. That pattern is important because markets that are about to crash usually don't behave like this. All right. Instead, they often fall hard for several days in a row. That's not what we're saying right here. Okay. So if the market wasn't falling, like I said, why wasn't it going higher either? The answer is something called consolidation. Now, don't let that word scare you. Consolidation simply means the market is taking a short break after a stronger move higher. Think about climbing a long staircase. You don't run all the way to the top without stopping. At some point, you just have to catch your breath and just, relax. Then you can continue climbing. The stock market behaves in a very similar way. After reaching record highs, investors often slow down. So some people take profits in the process, others wait for new information. And new buyers look for better prices, before jumping in again. The result is exactly what we saw last week. Prices move sideways instead of moving sharply up or down. But here is where things become really interesting because even though the market spent the whole week resting, it never broke below our, already determined 240,000 points. Why does this even matter? Because like I told you in previous videos, right? 240,000 points is acting like our, support level. Support means a price area where buyers are willing to step in and, buy. So the market stay above that, support level the entire week. That tells us the bigger uptrend is still alive. Now let's talk about another clue many people completely ignored last week. trading volume. Last week, investors traded about 2.819 billion shares. The week before that, trading volume was about 3.648 billion shares. So yes, trading activity dropped significantly, right? Should you panic? Not yet. In fact, lower volume during a sideways market often tells us a very different story. Now, imagine you're walking through a busy shopping mall, right? One day it's packed with people, the next day it's much quieter. That doesn't automatically mean the mall is closing down. Sometimes people are simply taking their time before making another purchase. The stock market also works in similar way. Lower trading activities doesn't automatically mean investors are scared. All right. Sometimes it simply means they are waiting. However, this volume thing is something we really need to watch closely because if prices keep rising, while fewer and fewer people are buying, eventually the rally can, lose momentum. For now, though, one quiet week isn't enough to sound the alarm. I noticed a positive sign, right, from what we call market breadth. Market breadth simply measures how many stocks went up compared to how many stocks went down. Last week, Friday, 30 stocks gained, while 27 stocks fell. Now, that was almost balanced. Why is this important? Because it shows money is still moving around inside the market. It's just moving from one group of stocks, right, to another. This is called sector rotation. Again, don't worry about the name. It simply means investors are moving their money from one industry to another or one sector to another. So where does this leave us right now? The market still looks pretty much healthy, not because prices went higher every day, but because they didn't fall apart either. The market is still sitting close to its all-time highs. Support is still holding strong. Investors are still buying selected, stocks, and there's no any sign of widespread panic selling. But this is where you need to pay close attention because the next move could tell us much more than last week did. There are two signals I'm watching very closely. The first one is the bullish signal. If the market starts moving higher again and trading volume also increases, that will tell us fresh buyers are coming back into the market. That's exactly what you want to see. More buyers, higher prices equals more confidence in the market. That combination usually supports a stronger rally. The second signal is the warning signal. So if the market falls below 240,000 points and that drop happens with heavy trading volume, then we need to take it seriously, very, very seriously, because higher volume means a lot of investors are dumping. That could be an early sign that the market upward trend is beginning to, weaken. Notice something important. It's not just the price that matters, it's the price and the volume together. So those two pieces tell a much more clearer story than each one of its own. So what's the most likely outcome going forward from here? Based on what we've seen so far in the market, right? The market still appear to be in a very healthy pulse rather than the start of a major decline. The bigger trends still remain positive, but not every stock will move together. This is becoming a market where being selective matters more than simply buying everything. Some sectors may continue leading, others may, slow down. That's why your job right now is paying close attention to where the money is flowing into. It's just as important as you monitoring every index of the stock market. Now, the big question is this: will buyers return with stronger volume and push the market to a fresh high, or will sellers finally take control and break the important 240,000 level? That's the battle we'll be watching very closely in the days ahead. And if you understand these signals before everyone else does, you will be in a much more better position to make smarter investment decisions, instead of reacting after the market has already moved. And note this, right? Sometimes the biggest opportunity don't appear during the loudest weeks. They appear during the quiet ones, when the market is quietly preparing for its next chapter. Now, if you're looking to get regular stocks recommendation or stock market tips for both Nigeria and US stocks, I have a Telegram channel where I share frequent market insights to enable you beat the market. So if you're interested, you can find the Telegram link in the description box of this video below. If you gain value from this video, please like and subscribe so you do not miss my next video. All right. Have a nice day. Bye.